Now let's move over to some of the more promising macroeconomic data to kick off 2025. The macro indicator that best reflects the business cycle is starting to wake up after being in recession for years.
We are seeing manufacturing recover. The ISM manufacturing posted one of the highest readings in almost 2.5 years. I mean, it's been below 50 basically for nearly 3 years.
If you look at the manufacturing cycle, it's been in a downturn over the past 2 years. And the reason why that matters so much for equities is because half of earnings for the S&P 500 is tied to the manufacturing cycle. It's been the longest downturn in history for manufacturing. And as that manufacturing cycle comes back, because the destocking cycle is over, the election overhang is removed, and I think CapEx cycle is going to accelerate again. If that's the case, I think that's going to be a major boost for earnings for an average stock, and I think that's really going to be the driver of the market broadening out.
Manufacturing is the most capital intensive sector of the economy. It is the biggest driver of economic activity and earnings growth. Once we get the ISM expanding above 50, that is a signal of a new bull market cycle.
If we're getting from here to 7,000 in less than 6 months, you're talking about, 35% annualized pace of gain. So how do we get there?
Just because the calendar year changed doesn't mean that the strength that we saw throughout 2024 suddenly has evaporated. There are tailwinds building because the Fed is dovish, even if they're making fewer cuts.
Now remember, the Fed is data dependent, so the employment report on Friday will give us some more visibility to how the Fed may shift their cutting speed going into the next meeting. Weaker employment forces the Fed to pull forward cuts. That's only going to accelerate the manufacturing cycle and push rates lower at the same time. This would be a bull market reset, causing initial concern, followed by more liquidity, lower rates, and more confidence in these cyclical sectors.
I think the labor market could be softening in a way, because whether you look at link-up data or the ISM employment, to tell us that the Fed now has to be focused back on supporting the economy. So I think this month could be quite decisive in the sense that we've got weakness because of some insecurities building, but I think it's, the same tailwinds are in place. I mean, I think it's still a buy the dip kind of market.
Now, whether or not the market corrects 10% or not, we can be confident that a lower inflation print should cap rates and broaden the rally.
I think the big term, the big picture, this will be an opportunity.
The sectors that we like are more cyclically oriented sectors, such as financials, consumer discretionary, materials, real estate, and utilities is kind of like our hedge against things going wrong. And I think the biggest driver of that rotation, like I said, is going to be driven by earnings breadth broadening out. I think the driver of that is going to be manufacturing cycle coming back.
Financial conditions should ease this year. Easing financial conditions does allow some cyclicals to post better earnings growth, like financials and regional banks, industrial.